Okay, people, it's a sea of red out there in the markets today, and we're going to go over the reasons why. But more importantly, we're going to look at how you can advantage your situation, even though we're looking at declining markets, declining equities markets. Now, why is this occurring? What's going on today that would make all of these indices, the Dow Jones, the S&P 500, and the Nasdaq, they're dropping off of a cliff. Why is that? Well, one of the reasons is because we are in an inflationary environment. Now, if you watch CNBC, which I don't, or Fox Business, which I don't, then you may have seen an interview with Jerome Powell, the Fed chair, or Janet Yellen, the Secretary of the Treasury, and they may be out there telling you that there's no inflation. That's a lie. That's a bold-faced lie, and it's not. I'm not even going to call it some type of misinterpretation, because these are very intelligent people. Now, in their personal worlds, they might not realize inflation is here because they are on the government dole. They're getting driven around in private limousines and private jets and eating off of government expense accounts for a large portion of the day, and existing in a world that is altogether different from the one you and I exist in. But here with us on Main Street, we know that food prices in the supermarket are up. We know that prices at the pump are up, and they relate, okay? If gas prices are up, and we're going to talk about gas prices at length in a minute and why they're up. If gas prices are up, then it's going to cost more to transport your steaks, your fruits, your vegetables, your chicken to the grocery store. And that cost is going to be passed on to you. We already also talked about in previous videos the fact that the Biden administration is looking at increasing taxes on corporations, on some high earners. And those taxes will be passed on to you, even though they swear that, this is only for the rich. No, you'll pay for that. So why are gas prices up? Why? That's kind of one of the underlying commodities in the economy that drives the price of almost everything else, because everything needs to be transported to the final destination before the consumer purchases it, so the store. So there are actually four reasons why gas prices are up. Number one, America has decided under the new presidential administration to constrain supply by cutting off certain pipelines throughout the country. We don't want to transport that oil by pipeline. And as I've said before, that is a nod to those companies that transport oil by train. Make no mistake about it, the oil is still being transported, but it's just not being transported via pipeline. It's still coming across the United States, but instead of in the pipeline, it's coming across in one of Warren Buffett's trains. Okay, and there are plenty of other companies besides Warren Buffett's Burlington Northern, Santa Fe, that do that work. But the rail industry is profiting from the shutdown of the pipeline. That's one reason. Okay, so it costs more to transport that oil by train than it does by pipeline. So you're seeing some increases there. Number two, we're going into the summer driving season. People drive more during the summer. And after last summer, 2020, when no one really went anywhere, we're definitely seeing the possibility for a big increase in travel by car. And most cars on the road today use gasoline. Gas prices usually increase in the summer for another reason, and that has to do with the different formulations of gasoline that are mandated by the government in order to minimize certain types of emissions, and that is a more expensive process. We've also got the Colonial Pipeline. You may have heard about this in the news. The Colonial Pipeline was hacked with a ransomware attack, and they are slowly bringing it back up to full speed, full capacity. That specter of not having that pipeline, which serves much of the East Coast and the Southeast, that possibility, the potential for that oil to be out of play, and it's 45% of the oil that comes through that area, that's a biggie, okay? And it's definitely going to add to increases in oil prices or gasoline prices, fuel prices, as that problem persists. The final factor, now you see we've got a lot of factors going on with oil. The final thing that's causing an increase is last year we had a lot of schools that teach truck driving. They were offline, okay? You couldn't go to the school, couldn't learn how to drive a truck. So we've got a shortage of hazmat certified CDL drivers who can actually transport that oil from a terminal to its final destination before the consumer, which is the gas station. Okay, so, or the airport, because jet fuel is carried in this pipeline as well, the Colonial Pipeline. So we've got all of those factors with that just one commodity that is driving the price of oil up, and therefore it's driving up the price of everything you buy, because what you buy has to be transported to you in some form or fashion. Now, how do you play this? How do you win in this situation? One thing you can do is you can look at investing in commodities. Commodities tend to hold on to their value. Commodities are typically a store of value. There's usually a pretty finite amount of the commodity available. Take gold, for example. Now, before I get into this, I am not telling you what to invest in. You have to do your own due diligence. This is just me going over the broad strokes of how this situation could be turned to your advantage. So gold pretty much purchases the same thing it purchased 2,000 years ago. It has held its value over time. And because of that, it's a good store of value. It's a good hedge against inflationary pressure, because that's the other thing that we are looking at right now is in addition to inflation, we're looking at interest rate hikes. I'll go over that in just a second. What's another commodity? Real estate. Okay, they're not making any more of it here on Earth. We've got a finite supply, and we have an even more finite supply in areas where people really want to live. So if you own a home, then making improvements to that home will likely, again, do your due diligence, likely increase the value. Now, increasing the value of your home is, the ultimate value is based on your location. But doing that could be a way to increase that equity that you hold in that piece of real estate. If you got a piece of rental real estate, depending on its location and other factors, because again, real estate is not a national market, it's going to not only rental real estate, not only hold on to its value over time, but it's going to provide you with some income and tax advantages as well. So that's another way to play that commodities market. Real estate is, it's a commodity. Review that. Look at different commodities, how they're holding on to their value, how they have held their value over time. And again, if it's not something you can touch, it's not a commodity. Okay? Touch and feel. It's not a commodity, or something that you can, somehow put your hands on tangibly. The other way you can play this is by investing in companies that are not necessarily as exposed to inflation or other price increase pressures throughout the economy. So, for example, not only are we dealing with inflation, but we're also dealing with the possibility that the Fed is going to try to slow this economy down and slow demand. Now, doing that will help control price increases. But the way to do that is by interest rate hikes. The Fed could come out and say, we're going to raise the discount rate, which would make it more expensive to borrow. And these companies are, reacting to that. They're reacting to the possibility that money could become more expensive. So what are some companies that aren't as exposed to inflationary pressures and aren't as exposed to interest rate hikes? You take a software company, for example. They're creating something that is not nearly as dependent on any type of commodity or tangible material. Theirs is a game or a business of intellectual property. So Microsoft is not going to need to really do any more in terms of production to create more Microsoft Office software packages. Then it costs pretty much the same to make 1,000 as it does to make 10. Okay, so therefore, it really behooves them to make more, because then the production that goes into that from the standpoint of intellectual property becomes less expensive. Their employees then become less expensive. So Microsoft or software companies are uniquely positioned to be able to weather that type of inflationary pressure. They're not as exposed to price increases as a company that goes out and creates a tangible thing like a car or a house or a cell phone, for example. So those are some ways that you can play this market and get in on some equities or some commodities in the case of real estate that are, lower at this point, lower than they may be in the future. Okay, that's the other thing. You might think prices are high right now, but you might look back 3 years from now and say, wow, what a discount I could have gotten. So you can't read the future, you can't time the market, but there's also the old adage, there's no time like the present. The bottom line here is you're going to have to put some of your money to work in some way, shape, or form. Otherwise, in an inflationary environment, it's going to lose value. Okay, you cannot put it in a savings account and expect for it to do anything with interest rates on savings well under 1%. You're not even you're not even keeping pace with inflation, let alone beating it. All right, so you've got to get that money working harder for you. Now we're here and we have products that can help you do that. Check out our website, mcenow.com. Contact us if you have any questions. We love to answer them. And until then, go out, do your due diligence, get with us if you need some help, and figure out how to make this money work harder for you. So one day you won't have to work as hard for it.